Artificial intelligence data centers are consuming electricity at a rate that regional grids simply cannot support. The physical infrastructure to run modern computation models requires uninterrupted, massive amounts of baseload power. To meet this rapidly accelerating demand, the federal government has set an aggressive policy target, expanding total U.S. nuclear energy capacity from 100 gigawatts to 400 gigawatts by the year 2050. Sitting at the center of this structural shift is Oklo Inc., an advanced nuclear technology company. It has become the market's most heavily scrutinized proxy investment for the future of domestic energy. This split-screen chart illustrates the central paradox of the company. On the left, we see projected U.S. data center electricity demand tripling to nearly 580 terawatt-hours. On the right, we see Oklo's fundamental profile, a market capitalization of roughly $10 billion, against zero meaningful revenue and widening net losses of over $33 million. Because the company generates no revenue, institutional expectations are severely divided. Wall Street price targets currently range anywhere from $14 a share to $140 a share. Oklo's premium valuation is entirely detached from its current financials. Buying the stock today operates strictly as a high-stakes bet on the company's ability to execute a timeline years in the future. Bullish investors justify this valuation by pointing to three specific operational pillars: Oklo's pristine balance sheet, its vertically integrated technology model, and its unique regulatory roadmap. To accurately assess the viability of this stock, we have to strip away the retail hype surrounding artificial intelligence and focus exclusively on hard, quantitative milestones. The primary risk is a matter of time. Oklo has to survive a multi-year execution gap, as it does not expect to generate any commercial power revenue until late 2027 at the earliest. Determining if Oklo can survive that gap requires systematically deconstructing how they plan to fund, build, and legally operate their conceptual 14-gigawatt customer pipeline. Looking at this comparison of Oklo's liquidity against its projected burn rate, their primary defensive asset is clear. The company holds roughly $2.5 billion in cash, equivalents, and marketable securities, stacked against projected 2026 operating expenses of up to $100 million and capital expenditures of up to $450 million. Much of this capital was raised through a massive $1.2 billion at-the-market equity program. That cash is strictly necessary to feed the heavy capital expenditures required by their specific business model. Traditional nuclear competitors operate by designing a reactor, getting it approved, and then licensing that technology out to utility companies who take on the burden of construction. Oklo uses a build-own-operate model. They intend to construct the plants themselves, retain total ownership, and sell the resulting electricity to data centers through long-term power purchase agreements. Funding multiple parallel infrastructure projects under this ownership structure requires immense amounts of upfront capital. The build-own-operate strategy positions Oklo to capture recurring revenue streams decades into the future. But in the near term, it directly subjects existing shareholders to severe and ongoing dilution risk to pay for the concrete and steel. The hardware driving this model is the Aurora Powerhouse, a fast fission microreactor built directly on the proven heritage of the historic experimental breeder reactor 2. This conceptual schematic traces the core engineering. The system uses specialized heat penics to transport thermal energy from the reactor core into a supercritical carbon dioxide power conversion system designed to output up to 75 megawatts of electricity per unit. Tech companies are interested. Oklo has accumulated a massive 14-gigawatt customer pipeline anchored by planned data center and tech campus deals. However, these agreements are currently non-binding letters of intent. They signal strong corporate interest, but they are not legally binding financial commitments. Converting those letters of intent into operating reactors faces a severe physical constraint. Fast reactors require high-assay low-enriched uranium, or HALEU, a specialized metallic fuel that is currently in a state of industry-wide scarcity. To solve this structural bottleneck, Oklo is forming a joint venture with Centrus Energy to establish domestic supply, while simultaneously building an advanced fuel center in Tennessee to recycle spent nuclear fuel. A flawless reactor design cannot generate electricity without specialized fuel. Oklo's ability to secure these supply chain logistics is just as vital to its valuation as the engineering of the reactor itself. Oklo operates with a deep structural integration within the federal government's energy framework, holding 3 separate projects inside the Department of Energy's reactor pilot program. This relationship has yielded early administrative wins, including the recent approval of their preliminary documented safety analysis, a key milestone in the fast-track authorization process. But the Department of Energy does not grant commercial operating licenses. To actually sell power to data centers, Oklo must secure full authorization from the Independent Nuclear Regulatory Commission. Knowing that commercial licensing takes years, management designed a strategic financial bridge called Atomic Alchemy, a subsidiary meant to generate cash before the power reactors go online. Atomic Alchemy recently received an NRC materials license, granting them the legal framework to produce and sell highly sought-after radioisotopes to medical and industrial sectors. Winning this isotope license is a crucial proof of concept. It demonstrates to investors that Oklo has the institutional competence to successfully navigate the strict requirements of the NRC. Retail sentiment heavily favors the stock, framing Oklo as the ultimate picks and shovels play for the massive artificial intelligence infrastructure build-out. Yet bearish analysts consistently point to a specific optic. Over the past 6 months, Oklo's co-founders have steadily sold tens of millions of dollars worth of their own shares. These sales are executed under prearranged Rule 10b-5-1 trading plans. While the volume is high, scheduling liquidity sales months in advance is standard executive practice, not an automatic signal of internal distress. This comparative matrix plots the sector based on regulatory progress and current revenue. NuScale, for example, operates with lower risk. They already have an NRC-approved design and rely on widely available conventional uranium, placing them further along the regulatory axis. Meanwhile, Centrus Energy sits at the top of the revenue axis. Because they hold the only U.S. license to produce HALEU fuel and carry a $3.8 billion backlog, they offer investors a completely de-risked proxy play on the exact commodity Oklo relies on. While peers offer safer regulatory pathways or immediate cash flow, Oklo trades at a premium specifically because its vertically integrated, ownership-driven model offers the highest possible long-term ceiling. The alignment between Oklo's product and future energy markets is driven by a concrete shift in data-driven demand. The global tech industry requires vast amounts of firm, carbon-free, behind-the-meter electricity, and Oklo's hardware is designed for that specific application. This visual represents the execution bridge the company must build. They start from a secure position of a $2.5 billion cash runway on the left, but must cross a multi-year chasm before they can reach potential commercial revenue in late 2027. The downside risk during this crossing is severe. A prolonged shortage in the HALEU supply chain, a sudden contraction in AI capital expenditures, or a single bureaucratic delay at the NRC could rapidly collapse the stock price. The first mandatory step across that gap arrives on July 4, 2026. This is the Department of Energy's deadline for Oklo's Groves isotope reactor to achieve nuclear criticality. Reaching criticality exactly on this timeline is the required catalyst to prove to Wall Street that their baseline engineering is physically viable. Following that, they must successfully scale up and deliver radioisotope sales, generating the first real operational cash flow to sustain their balance sheet. Finally, those 14 gigawatts of corporate interest must be converted from non-binding letters of intent into binding prepaid power purchase agreements. Hitting these specific sequential milestones is the only way Oklo can transition from a highly speculative story stock into an operating utility and ultimately validate its $10 billion thesis.